Hi guys, welcome back to this week's Technical Insights. Singapore shares ended the week sharply lower, tracking regional losses in the Asia-Pacific market last Friday, 20th of October. Rising yields and heightened geopolitical tensions continue to weigh on market sentiments. STI index fell 0.74% or 22 points to close at 3,076 points. On the broader Singapore market, losers beat winners 341 to 256. About 1.5 billion shares worth a total of 1.1 billion Sing dollars were traded. Key markets in the Asia region again ended in a sea of red as of close last Friday. South Korea KOSPI index sank 1.7%, leading the decline. ASX 200 also fell 1.16%. Shanghai Composite dropped 0.74%, and the Nikkei 225 dropped 0.54%. For the week, the yield of the benchmark 10-year US Treasury crossed 5% for the first time in 16 years. This 5% level could ripple through the economy by raising rates on property mortgages, credit card, vehicle loans, and more. Not to mention, it offers investors an attractive alternative to stocks. The Dow Jones Index lost 1.61% for the week to end at 33,127 points. The US Bank tumbled as higher rates raised worries about the sector exposure to the Treasury securities that are falling in value. The S&P 500 dropped 2.39% and registered its first losing week in 3, finishing at 4,224 points. Tech-heavy Nasdaq Composite was the worst performer for the week, tanking 3.61% to close at 12,983 points, breaking the 13,000 psychological barrier and notching its second straight week of losses. In Asia, the benchmark CSI 300 index fell 4.17% for the week to 3,510 points. Global funds took another 3.3 billion off the table this week from the A-shares market, a record pace of pullback over the past 10 weeks. The Hang Seng Index tumbled for 3 days in a row and was down 3.6% for the week, ending at 17,172 points. This is the biggest weekly loss in 2 months for Hong Kong stocks, and a rebound in Chinese equity will be much longer delayed as the China property debt worries continue to dominate the markets. Locally, our STI index fell 3.42% for the week as investors took stock of the rising geopolitical risks and the soaring US government bond yields. Local bank DBS, UOB, and OCBC all fell for the week. DBS was down 2.04% to $33.08. UOB led the decline, down 2.05% to $27.76. OCBC slipped 1.47% for the week to end at $12.79. SGX also ended the week lower, down 1.84% to $9.59. All STI components ended last week in the red except for Emperador, who finished flat at 50.5 cents. Yangzijiang Shipbuilding was the biggest loser on the STI, falling 12.27% in the past 5 trading sessions to $1.43 on Friday. For this week's technical analysis, let's look at both Emperador and Yangzijiang Shipbuilding. First, let's look at Emperador Inc., which is the only STI component stock that did not finish the week in the red. Emperador is Philippines' biggest liquor company and the world's largest brandy manufacturer. Their company was listed on SGX and started trading last year on the 14th of July. Emperador is a company which engages in the manufacturing, bottling, and distribution of distilled spirits and other alcoholic beverages. It operates through the brandy and Scotch whisky segment. Their brandy segment represents the United Kingdom operations, and the Scotch whisky segment operates mainly in the Philippines, Spain, and Mexico. Their distilled spirit and other alcoholic beverages are currently available in 55 countries across continents of Asia, North and South America, Europe, and Africa, and in 300 airport retail stores worldwide. As you can see, the company has a short trading history of about 1.5 years. Their stock price opened on 14th of July at around 44 cents. And the highest the price of the stock ever reached was about 53 cents in August of last year. Fast forward to this year, the year-to-date high was seen at 52.5 cents between the period of June to September. Year-to-date was observed in January at 49 cents. The stock recently tested its long-term 200 days moving average support at 50.5 cents, and the October low was seen at 50 cents as well. So I would say that this 200 days moving average, the red color line that you see here, is still intact. Below this 200 days moving average support, the next support level will be at the year-to-date low at 49 cents in January. Resistance will be the recent high in September at 52.5 cents, and above this, the next resistance may be the all-time high around the 53 cents level at August last year. Last week, the 20 days moving average, which is the white line that you see here, crossed below its 50 days moving average, a sign of short-term weakness. The MACD indicator is showing signs that the downtrend momentum is subsiding in the past 2 weeks, according to the MACD histogram. The latest RSI reading is now a tad below the 50-point neutral mark, reading as 46, signaling that momentum is still weak. Given that the stock is quite resilient to major pullbacks in the market, the 50 cents level looks like a good accumulation level to target the September high of 52.5 cents. Next, let's look at Yangzijiang Shipbuilding, and I think this stock needs no introduction. Last Friday, the stock dropped about 1.38% to $1.43. For the week, it fell more than 12%. So is this the right time to go into Yangzijiang Shipbuilding? First, let's take a look at some of the key levels. The year-to-date high was observed at $1.79 on the 29th of August. And the year-to-date low was seen on 5th of January at $1.09. The stocks has declined more than 20% since the year-to-date high at $1.79. The first support level will come in around the 200 days moving average level, which is the red line, at $1.37. If this is broken, the next support will come in the 23rd June low at $1.27. Resistance level to watch out for will be the 14th July high over here at $1.55. Above this will be the 20 days moving average level, which is sloping downwards at $1.59. So the MACD indicator is indicating that the downside momentum is still very strong, as the MACD line is still seen diverging away from the signal line, and both of the lines are sloping downwards as well. The RSI has breached the 30-point oversold level at 25, which is also the lowest reading recorded this year in January. Since the RSI has triggered the oversold signal of below 30 points, we will wait for the MACD to show that the signs of the downside momentum is subsiding before considering an entry at the 200 days moving average at $1.37, or even the 23rd June low at $1.27. And that's all I have for this week's update. As usual, if you find this useful, we appreciate you giving us a like or a share, and consider hitting that subscribe button to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.